Hello, my name's Rob Mintz, and I'm here with my colleague Elizabeth Osborne, and we are delighted that you've joined us to talk about EB5 projects, a unique capital and finance strategy for U.S. companies. I'm a partner at Stahl Cowen, and I focus on in the corporate transactional area, and I help people structure their businesses, buy and sell companies, and most importantly, help them raise capital. Liz and I will provide an overview of and discuss today the anatomy of an EB5 deal. EB5 is an investment-based immigration program that yields a green card. Green cards cover the investor's spouse, and children under the age of 21 years old. In my opinion, EB5 provides the most efficient, i.e. cheapest variety of capital on the planet. Investors are generally seeking a 2 to 4% annual return and their money back in approximately 5 years. Our talk today will be mostly in general terms, because this really isn't the proper venue to go into all the nuances of an EB5 transaction, but at the conclusion, I think you'll have a good idea of how EB5 works. Liz, you want to say hi?
Sure. My name's Elizabeth Osborne. I'm also an attorney with Stahl Cowen, Crowley Addis in Chicago, Illinois, and I specialize in business matters and estate planning and, of course, EB5 capital raises. And I'm delighted to be here with Rob today to give you an overview of how to properly structure an EB5 investment project. Now, with that intro out of the way, if Rob, you'd like to give just a basic history of the program from where it derived, so we get a feel of the purpose behind it.
Sure. So EB5 was created in 1990. Why? To spur job creation. What was happening in the late 80s? The U.S. was going through a period of higher unemployment coupled with lack of investment. It was just past the end of the Reagan era. That was when you were still like in kindergarten and grade school, Liz.
Exactly.
And I was in my early years of practicing law, and the economy had stagnated. So since its creation in 1990, it's expanded over the subsequent years to, and participation has grown. Moreover, rules and its administration have become more consistent and transparent, leading to a large increase in popularity. The Immigrant Investor Program, commonly known as EB5 program. By the way, Liz, what does E and B stand for?
Employment based.
Okay, just for those people who are keeping track, Liz, that's 1 point to Liz so far.
Check.
Check. All right. The EB5 program was part of an overhaul of the U.S. immigration system. The purpose, as we mentioned a moment ago, was to stimulate the U.S. economy and create U.S. jobs by giving foreign investors the opportunity to permanently live and work in the U.S. after they've invested in a U.S. business. In short, if a foreign entrepreneur invests money into a U.S. business, and as a result of that investment, at least 10 full-time U.S. jobs are created, then the foreign investor, his spouse, and children under the age of 21 all receive green cards. For children, from a family perspective, the importance of that is that the kids then get to go to school in the United States, whether it's elementary school, high schools, or college. It makes it easier for them to attend school in the U.S. and get a U.S. education, which is high value. Okay, so since its inception in 1990, the program has undergone lots of reforms and has evolved. In 1993, for example, Congress expanded the program to enact the Immigrant Investor Pilot Program, which allowed for EB-5 regional centers. We'll talk about regional centers in greater detail a little bit later, but essentially regional centers are separate business entities that have received a special designation by the U.S. CIS, United States Citizenship and Immigration Service. That's the governmental arm that monitors EB-5 applications. And then those regional centers administer and oversee EB-5 investments and the jobs that are created. Through the 90s, there was lax regulation of the program, some fraud in investments. As a result, the U.S. Citizenship and Immigration Service tightened the rules, requiring investors to demonstrate the source of their funds to be sure that they were legal. The number of EB-5 applications significantly dropped after those regulations, and by the early 2000s, there was a great deal of uncertainty in how the EB-5 visas were to be reviewed and what it would actually take to get an approval. The government really did not have a centralized or consistent adjudication process. As time went on, however, the U.S. CIS provided more guidance and formed a specific processing center to oversee the EB-5 process. And nowadays, the program has become much more reliable. As a result, popularity of the program has increased exponentially over the past 2 years. For example, in 2006, there were only 744 EB-5 visa applications filed. By 2009, just 3 years later, 4,200 EB-5 applications were filed, and currently it's projected that we will max out on the EB-5 allotted visas, which is 10,000. All right, that's enough on the history of EB-5, just to give you, an understanding of the theoretical underpinnings of why the program was created and how it's evolved a bit over time. All right, there are 3 key factors leading to interest in EB-5 financing. First, foreign demand for U.S. green cards,
which you touched on a little with foreign investors really valuing being able to send their children to U.S. schools. So that is a key driver in a foreign investor making an EB-5 investment, is being allowed to bring over his family and children with him to the United States, and particularly in a more expeditious manner than many other family-based visas are processed.
Right. A secondary consideration is that it allows business owners, non-U.S. business owners, to sell their products or services here in the U.S. It makes it easier for them to expand their non-U.S. businesses into the U.S., i.e. the world's largest marketplace, by having a green card. And then thirdly, some people believe that it's a status symbol to have a U.S. green card and have the opportunity to come and go in the U.S. as they please. So that's really wonderful. That's one key factor, the foreign demand and why. Another one is high unemployment in the U.S. At its core, it's the EB-5. EB-5 is a job creation program. So there's high interest in the U.S. by local governments to employ more people. And thirdly, there are inherent limitations on traditional financing in the U.S. So over the last 5 years in particular, with the economic downturn, banks have not lent money as readily. Along with the fact that when they do lend, they require more owner equity, So there's less leverage in deals, and there sometimes is a gap. For example, if a project costs, let's just say, $1 million, and let's use a higher number, $5 million, and the U.S. owner has $1 million of capital, can get a $3 million bank loan, 1 plus 3 is 4, there's a $1 million gap, using EB5 financing can plug the gap and provide the capital for the project so that it can get going. So it's a wonderful thing. One short note on how professionals, lawyers, accountants, economists interact and get involved with EB5 transactions. The lawyer part, I think, is pretty straightforward. There are documents to be filed with the United States USCIS, and there are contracts to be undertaken between the investor and the company in the U.S. Well, we've found that companies that work closely with their outside accountant do better in EB5 financings because the accountants have to prepare projections and help out with business plans and in part which go into the private placement memoranda. Also, economists are sometimes used to verify the number of jobs and predict the number of jobs created.
Correct. Right, so an economist becomes important because, again, the key underpinning of an EB5 transaction is job creation. So expanding on that, why don't we go into the mechanics of the EB5 program, and just in general, how much capital can an EB5 financing project provide for a U.S. company? Well, there's no cap. There's no maximum amount of money you can raise, but it's tied to how many jobs you can create. So each investment unit must provide enough capital to create, directly from that investment, 10 full-time jobs. So for every investor in the project, you must create 10 jobs per investor. Now, an investment unit can either be $1 million, a $1 million investment, or it can be reduced to a $500,000 minimum investment, depending on the location of your project. If a project is located in what's called a targeted employment area, or a TEA for short, then that investment threshold can be reduced to $500,000. Because a targeted employment area is an area that has is determined in two different ways. One is...
Liz, quick question first.
Sure.
So are you telling me that my cousin in Brazil can invest in the U.S. if the U.S. business in which my cousin invests is located in a TEA, all he has to put in is $500,000?
Correct.
And if that business, if the same business just happens to be located across the street or down the road or across town, not in a TEA, then my cousin has to invest $1 million?
Yes. So location in a TEA is so important to the success of a project because an investor will say, well, why should I pay $1 million for my same end result of a green card, where I can go down the street and just pay $500,000.
Okay, hint to all of you out there. You want to make sure that your business, if you're embarking upon an EB5 project, capital raise project, is located in a TEA. Liz, what's a TEA?
A TEA is a geographical area that is either rural means population of under 20,000, or not located near a metropolitan statistical area. So basically, not near a large city and a small population. Or more commonly, a TEA is determined by looking at an unemployment rate for a particular area, usually by census tract, and an unemployment rate that is at least 150% of the national average will qualify as a TEA.
Right here, I'm going to stump Liz. What was February's on February 2014's national average unemployment rate. Now I'm going to get her now.
Was it 12.2?
No. No. Okay, Rob won. Liz won. I'm catching up. Okay. February's rate was 6.7%. I thought that was low. I had a higher number in mind. So if you multiply that by 150%, you get 10.05% for a business, for the unemployment rate, for the area in which the business is located, qualifying for as a TEA, and that $500,000 investment versus $1 million investment per investor.
Okay.
Ha.
And
so happy.
Right. Okay. You win.
All right.
This battle. One other point about a targeted employment area, sometimes people get the impression that a TEA is a bad neighborhood or something like that, but it's really not. The unemployment rate can vary literally by just a few blocks from one area to the next. You can find a TEA in the northern suburbs of Chicago, for example, has TEAs readily available and for projects to be located in. So it's really a question of analyzing data, and data can be manipulated in such a way that you can combine geographical areas and get to that threshold number you're looking for, which is, again, really important in the marketability aspect of a TEA, an EB5 project, and we'll expand on that again later. The next element of an EB5 project is the job creation, because again, for every investor, you must create at least 10 jobs. There are two types of jobs that are counted for this analysis. There are direct jobs, meaning the project itself goes out and hires 10 people based on the infusion of capital from EB5 investors. These must be employees, not independent contractors, and they must be full-time, 35 hours per week, not temporary, and not seasonal. Two part-time jobs do not equal one full-time job for EB5 financing. That's a common question. But if you have one full-time position that two people fill, you can still count that one full-time position even though two people are working it, but you cannot count two part-time positions. Where a project is not itself going to hire the requisite number of employees, you can rely on what's called indirect job creation. The concept here is that by virtue of your project going into an area, the surrounding economy will be affected in such a way that jobs will be created in the area surrounding your project. So a common example is I put a hotel in one area, and as a result of that hotel being there, someone else puts in a strip mall down the street, and that strip mall generates 100 jobs. So you did not directly hire the people that are now working down the street, but by virtue of your EB5 project, more jobs were created. This is where the economist comes in, because he will look at your project and analyze the makeup of it and determine a multiplier to see how many indirect jobs are projected to be created based on your project. One other caveat about using indirect job creation numbers is that your project must then be affiliated with a regional center. A regional center is a USCIS approved entity, so sort of like its own little EB5 business that oversees a certain geographical area and certain investment sectors.
Right, categories. And by that we mean some regional centers focus on hotels. Others focus on, it seems like they focus on one particular type of work. Hotels, restaurants, real estate, manufacturing companies, and you can pick and choose which regional center you want to work with based on their expertise.
Right. And so the regional center has already been approved by USCIS to assist in overseeing these EB5 projects. and make sure that a project that falls under its purview is following all of the EB-5 rules. So because of that additional oversight, the government will then give you some leeway in your job creation statistics and allow you to count these indirect numbers in meeting your job creation quota.
Are there pros and cons of working with a regional center?
Of course. A pro would be certainly the indirect job
Indirect
creation.
jobs,
I
right.
mean, that's
You get
really
more.
the main.
Get the multiplier.
Exactly. The con is it costs you money. You have to pay the regional center. Oftentimes, fees are structured on a per investor basis. So the regional center will charge you a certain dollar amount per investor in your project. And there will be annual fees for the regional center to continually oversee you. So it's a cost factor analysis, but where you cannot create enough direct jobs yourself relative to the amount of capital you want to raise, you know, the cost of associating with the regional center might well be worth that trade-off to get yourself up to those job numbers you need.
So you have to make the analysis on a deal-by-deal basis.
Right.
How about construction jobs? Are those included?
Construction jobs historically were not, but the rules have been revised in the past few years so that they can be created. However, you have to show that the jobs will last at least 2 years. So if your project is going to be built in 6 months, then you cannot count the construction jobs. But if the project is ongoing, such that construction will be, you know, ongoing for at least 2 years, then yes, those will count as a direct job and can also be factored into the indirect job creation analysis.
I have a question about something that you mentioned a few moments ago, and let's make sure that it's crystal clear in everyone's mind. Part-time jobs versus full-time jobs. The requirement is full-time equivalent jobs.
Right.
Whether one person fills that or more than one person fills that. If there is one job, receptionist, let's say,
right.
There's one receptionist job, 2 people can split it, but
exactly.
It counts as one job towards your goal of getting 10 jobs.
Correct.
Okay.
Exactly right. Another point for you.
She's going to end up winning. I want to tell everybody right now, she's going to win by a large margin. So I'm reveling in these very small victories right now. Let's talk for how corny are we, or am I? How corny am I? I don't want to negatively associate any of that with Liz. It's all me. It is, and I spur her on when we're together. Okay. Financing and marketability to foreign investors. What's the nature of an EB-5 financing? We say EB-5 financing. Finance connotes borrowing, i.e. a loan. It can't be a loan. It has to be, the money has to come in structured as equity capital with the attendant investment risk.
Yes.
So it's not as if the foreign investor can make a loan to a U.S. company, you know, with an interest rate and repayment schedule. The money has to be at risk with a risk of loss. The investments, those equity/capital investments, are subject to U.S. securities laws, and we strongly recommend and advise principals to use a private placement memorandum, PPM, to comply with Reg D, Regulation D of the U.S. Securities Act. A PPM, proper PPM, requires full disclosure of all elements of a deal, a description of the company, its principles, what the money is going to be used for, how much equity the money represents. You know, my cousin's $500,000 investment unit into the business that's located in the TEA, which means 500,000, not the million, means that he owns what percent of the company? Is it 1%, 5%? 10%, whatever. It has to all be spelled out. In addition to which, all the various risks of the investment must be pointed out in a PPM as well, and a description of any shareholders agreement for if you're using a corporation, or an operating agreement if you're structuring the business as a limited liability company, or I guess a partnership agreement if you structure it as a partnership. Okay. Commonly, so I just gave a speech on the fact that the investment has to be structured as equity.
And at risk.
And at risk. All right. Put that off to the side for just a moment, please, and indulge me. The most common structure for EB5 investments, and I know it may be hard to picture this at home, is for the investors to invest in entity one, where they will be a shareholder in a corporation, member in an LLC, i.e. an owner of entity one, thereby satisfying the investment risk of loss requirements. But that entity one then turns around and loans money to entity two, the operating company that's doing the product, making the product, rendering the service, creating the jobs.
So
did everybody catch that? Did we catch that?
Put another way, this investor makes his investment into entity one in exchange for his ownership interest. So puts his money in there. It's fully at risk in entity one. Entity one is a single purpose entity whose sole function is to take all of the money it gets from foreign investors and loan it to operating co, entity two. Entity two takes all of that money it gets and uses it to fund its project and create jobs. So there is a loan structure, but it's not between the investor and the operating company. It's between entity one and two.
There is an interim entity inserted into the structure.
And the reason that's desirable to investors is that sort of in a backwards way, they do get some collateral or some security for their investment because of the way the loan is structured between entity one and two.
Which may present a problem with operating companies outside bank. There will likely be if the business also needs to borrow money from a bank, there will likely be a subordination agreement that has to be entered into whereby the investors in entity one subordinate their rights to security or collateral in the project to the rights of the bank. Okay, if you're not completely and thoroughly confused yet, and you're with us, let's continue.
One point about this structure, though, is that because entity one, the entity in which the investors are making their investment, is not itself hiring anybody, it's not creating direct jobs, you must then, this project must affiliate with a regional center so that it can rely on indirect job creation.
Okay, so now we've talked about the structure or why EB5 came about and how an EB5 deal in an investment is structured. What happens on the immigration law side of the equation?
So when an investor makes his investment and puts his money at risk, he deposits it typically into an escrow account for the project. And it sits there while his petition for a visa, known as a Form I-526, is filed and adjudicated by USCIS. So
and adjudicated is a fancy word for approved.
hopefully approved.
Right.
It's reviewed.
Right.
And
sometimes they're
hopefully
rejected, but you can. There's an appeal process, and you can
Right.
provide additional information and get it approved.
So the I-526 petition is the document and memo and exhibits by which the investor shows the detail on the project itself. So it shows USAS the PPM, the job creation statistics, the economist report, to show that his investment is going to create these 10 jobs. And also the investor submits information on himself to show that he is in fact eligible for a visa. He's not a member of the Communist Party, no criminal background, etc.
Uh-oh, my cousin's going to have trouble.
So once the I-520...
Even if I lose to you in our competition, I think I'm going to have a higher total of like little quips. Okay, keep going. Sorry.
So once the I-526 is adjudicated, if there's an approval, then that's typically when the money comes out of escrow. It's released upon approval. Although processing times are starting to creep up. Usually takes at a minimum 6 months, but it's been more lately, maybe up to a year for USCIS to issue a decision on an I-526. So given that the processing time has taken longer, there are trends to structure an investment so some money can come out of escrow before an adjudication. But putting that aside, typically money sits there until there's an approval, then it's released. Upon a release to the project. Upon an approval, the investor is issued or then files for a visa and is issued a conditional green card. And that means that they get a green card, but it's only good for 2 years. And just prior to that 2-year expiration period, the investor must then file another form with USCIS called the Form I-829, in which they petition to have those conditions removed. The conditions are essentially just that you have to show that the jobs you promised would be created pursuant to your investment were actually created. So when you file your I-829, you show, maybe W-2s, or you show that the business plan was adhered to and, the economy was impacted the way the economists projected. And then once you can establish that the jobs you promised would be created were actually created, your I-829 is approved and your green card becomes permanent. And that's that. So like I said, with the timing, it can vary greatly. Times are creeping up as the program becomes more popular, but it is definitely several months, perhaps a year, to get an adjudication on an I-526.
All right, so let's examine that for just half a moment. I'm the business principal, and I'm starting NewCo. I do the EB5 capital raise, right? I find high net worth foreign individuals who are willing to invest in my company. I do the PPM. They say yes. They fill out all the paperwork. The I-526 including, not only do they file the paperwork, they write a check.
Right.
The check gets held in escrow.
Right.
The I-526 is filed, and until it is conditionally approved, the money stays in escrow, and we're just waiting.
Yes, it does stay in escrow, typically. Given the increased processing times and that projects need the money faster, there is a trend towards structuring at the escrow where some of it can come out before they're all approved, instead of waiting for like a 500,000 comes out at one time, like leaving a set pot in there, because typically there is a 20% disapproval rate. Okay, so for every 10 investors, perhaps USCIS turns down 2. So there are ways that people will structure a project so that at least 20% stays in escrow until the very last investor is approved, so that if someone were denied, there's money to give the person their portion back, but money can still trickle out to an investor so they can keep their project going. So there are ways to get money out of escrow sooner if necessary, but historically it stays in there until there's an approval. There's also that a project could use perhaps bridge financing to start and then use EB5 proceeds to pay off a loan.
Right.
There's ways to get a project moving faster as opposed to having to wait a year until you get $500,000 out of escrow.
Right. And, from a practical standpoint, the typical EB5 deal, size-wise, is somewhere in the $3, $4, $5 million, perhaps more range. So let's assume for a moment, for purposes of this discussion, that the business owner needs $5 million and that his business is located in a TEA. So $5 million divided by 500,000 means that he's going to have 10 investors. 10 investors are going to come and invest in his company. Their I-526s will likely not be filed all on the same day.
Right.
And theoretically, even if they were, because, investor 1 says yes on Monday, investor 2 says yes on Wednesday, investor 3 says yes a week later, and so forth and so on, you know where I'm going. And there's a bit of a time lag. But as the investors put their money in and their I-526 is filed, it's possible, not unlikely, that the USCIS could review the application of investor 3 before investor 1 or 2. Yes. It's a little bit random. They do a pretty good job, but it's a little bit random. And from the business owner's point of view, think about it. You need $5 million for your project. You're getting the money in dribs, and you're getting the money released out of escrow in dribs and drabs, unless you've negotiated with your investors up front that X number of days after the I-526 has been filed, maybe you get a third of the money, half of the money released out of escrow, or some other percentage, to make it easier for you, so that you're not forced to stop your project until all the money has been released.
Right. And also, there's another concept of administrative fees that comes into play here to kind of ease the U.S. company's burden. An investor will not only pay the $500,000 investment towards creating jobs, but also, in addition to that, they'll pay typically $40,000 to $50,000 in administrative fees. That's extra above and beyond the investment. And those funds are supposed to be used to defray the costs of the U.S. company. So we'll cover legal fees the company's incurred, the cost of the economist, the cost of
the
regional center,
yeah.
Costs of
the accountant,
other experts. All of these ancillary costs that the U.S. company incurs in setting up its project can be defrayed by this $40,000 to $50,000 per investor. That does not need to be tied directly to job creation the way the investment does. However, that money usually sits in escrow too, and it's usually refundable if in the event of a denial, just based on marketability. Again, if an investor sees one project, where all of his money could be returned in the event of a denial, or another project where he risks losing $50,000, why wouldn't he go with the safer option? So it's still a bit of a waiting game.
Right, and the benefit of which, the pot of gold for the business owner at the end of the rainbow, is that it's a less expensive form of capital because you're only paying out, as I mentioned before, 2 to 4% on an annual basis, and their money back in 5 years, more or less.
Right.
So the question you have to answer is it worth it for me to have a bit of a disjointed capital raise, i.e. not getting all the money at once, having it be free and clear, versus waiting and having it come out in bits and pieces. Okay, so that's a business decision for you business owners out there. Okay, what makes EB5 deals marketable to foreign investors? First and foremost, guess. Is the project located in a targeted employment area, in a TEA? Why should the investor put in $1 million for a project to get the green card when he or she could just as easily invest half that amount, $500,000, with the same results? These are successful and sophisticated people. Moreover, there are abundant EB5 projects around seeking money. The countries that we're seeing the most activity in are, in this order too, China, India, Russia, Venezuela, and South Africa. Make sure your project is located in a TEA. Okay, what's another consideration for the investor? The likelihood of success of obtaining the green card. How likely is it that if I put my money in, that I'm going to get a green card at the end of the application process? What we do here at Stahl Cowen is we provide on behalf of our U.S. businesses, a legal opinion on the EB5 structure. We don't opine on the investor, him or herself, but we provide an opinion on the deal. Is the deal EB5 compliant? Is the job creation analysis sufficient? Is there adequate risk of loss? All the prerequisites of a successful EB5 project, do they exist? Another area of emphasis is there a job creation cushion? So we've been saying over and over again, for the project to qualify as a EB5 deal, you have each investment unit, whether it's 500,000 or $1 million, has to create 10 jobs. Well, if your project is thinly estimated to cover the 10-job requirement, it's going to be less saleable than if you have a cushion. We advise our clients to target 13 or 14 jobs for each investment unit, not just 10. It makes it a lot easier to raise the money. Okay, other considerations. Has the company or any of its principals done an EB5 project in the past? Do they have a track record? A company doing a second or third EB5 deal is less risky and more apt to be able to raise the money than doing it for the first time, whether that's the company itself or the company's senior executives. Having experienced people on your team that have gone through the EB5 process makes your project more saleable. We also talked a little bit earlier about how soon will the investor recover the investor's money. Generally speaking, what we're seeing is that the investor's looking for their capital back within a 5-year period, and that's due to competitive pressures. There are deals out there where investors are being promised their money back in 2, 3, 4 years. The shorter time period of providing the investors with their money back, the better off and stronger the deal is. It's not guaranteeing the money back by X number of years or X date, but it infers or creates an expectation of when they can reasonably expect their money back.
It's creating a story to tell the investor how they'll be paid back, and having a good story, having a good exit strategy, so that it's clear that in 3 to 5 years it is extremely likely that their investment will be returned.
And what are those? Exactly right. And what are those exit strategies? There's a couple different categories. Operations, the business has cash flows. Are those cash flows sufficient to repay investors? Perhaps set up a reserve from cash flows to be funded that will later repay the investors. Another typical way exit strategy for a business is the sale of the project, sale of the company. For real estate, build a hotel and sell it serves to convert the asset into liquid form, and the investor gets his money back. You could go public. That's another way to ensure that the money gets paid back to the investors. You can refinance. Business grows according to projections. Find a bank that will make a loan to the company, use the proceeds to repay the investors. Last one, I'm reluctant to mention, but it does exist. The investor could also foreclose on the U.S. business and sell its assets and recover enough to pay them back. Hate talking about that one, but it does exist out there. What is an EB-5 investor's priority relative to others? Well, usually the senior lender, the outside bank, will have first priority. But relative to other investments or the promoter / owner of the deal, the investors will be ahead of them. So EB-5 rules allow for the investor to be a preferred investor but not have their investment be guaranteed. Some other miscellaneous factors. What's the business's investment track record? How have they done before? Have they raised money before, whether it's whether in an EB-5 project or just raising money in the past non-EB-5? Same thing with the management team. Have they done anything in the EB-5 world, or what's their background? What's their education? Have they succeeded in the past? How strong and perhaps more importantly, how reasonable are the financial projections? Has the attorney, economist, accountant looked at job creation, looked at the reasonableness of projections of the business's story? Other things to consider are, is your business simple? It's hard to explain while on one hand, it might be difficult to explain green power or some esoteric medical device to a foreign investor. It's a lot easier to explain a restaurant or a hotel to a foreign investor because they have those in their home countries. Restaurants and hotels, hint, hint, work food, easy manufacturing. Those deals are highly understandable and get funded before perhaps more sophisticated projects. Another thing to consider is there any connection between the business investment and the foreign investor's home country? Are there officers that, if you're raising money from China, for example, does anybody on your team speak Mandarin? Have you done your promotional video in Chinese, in Mandarin, or some other, or whatever dialect? Does the company currently do business in that foreign country. A lot of, for example, going back to the hotel idea, Marriott, if you're planning on building a new Marriott hotel, Marriott certainly does business in so many different countries. It would be a name that the investor would be quite familiar with, and therefore making it highly likely for you to be able to raise your money in that country. It's not an absolute requirement, but as you can see and imagine, it just makes it a little bit easier. Okay, so where do EB5 investors principally come from? Mentioned before, China, South Korea, India, Russia, Venezuela, South Africa. European countries, not quite as popular because they have other immigration treaties already with the U.S. China does not. So EB5 projects are highly effective. Okay. Summary. Here we go. There are many restrictions on immigrating to the United States. Through an EB5 transaction, the basic concept is that if you have money, you're willing to invest it, put it at risk in a project that creates 10 jobs, you can get a green card. That's why the program is often referred to as monetizing the green card. And from the U.S. side, what's the benefit to the United States? Wonderful job creation. And therefore the government fully supports it. And from the principal company owner standpoint, the ability to access capital at a very low rate and cover any gap left by traditional financing is worth its weight in gold. So that's it for the formal part of our presentation. And let's see if there are any questions out there. Liz, here's the question. How do you find EB5 investors?
So the easiest way to find an investor is to have some sort of contact, some agent out there in a foreign country who can directly communicate with those high net worth individuals who are looking to make an investment. In China, for example, Stahl Cowen has a representative with whom we work that seeks out investors and helps vet investors to make sure that they would be approvable, so to speak, upon filing an I-526. It requires a commitment to, be abroad, to send someone abroad, to have a presence abroad, and make a name for yourself in that foreign country so that you build up a reputation and you're reliable and known as being part of the EB5 world. In China, for example, there's hundreds of conferences that people put on trying to sell investments, and the market's flooded with them there because it's so popular. So, you got to dive in.
And it's relationship based. I'm wondering too, I would imagine that many regional centers can provide an entree for the U.S. companies who's seeking capital, point them in the right direction to raise the funds.
Regional centers will help find investors for projects as well. It's another pro to using one.
Okay. I did some online research and came across the acronym RFE. What is that?
RFE stands for Request for Evidence. When an investor files an I-526, as we talked about earlier, you submit all of this information describing the investment project and describing the investor, and that he or she is a suitable investor. But also a key component to the I-526 is the investor showing the source of his funds. You have to show that the money came from a legal source.
And trace it all the way back. I'm in Brazil. I sold my business. Really? Show me. Show me a closing statement. Show me the purchase agreement. Right.
And then oftentimes you have to take it a step back.
Show me where the bank funds are.
Right, well, exactly. A definite trace of funds from bank to bank to bank until the money reaches the investment's escrow account. Oftentimes, China has restrictions on wiring money out of the country. You have to do it, in $50,000 sums. Investors
Increments,
need to
right.
use their friends and family to get the money over here. You need wire receipts and an exact flow chart with paper evidence to show how money got from point A to point B. And even so, back to your I sold my business example, USCIS, you could submit a I-526 that says, I sold my business, here's my chain of flow. USCIS could send you an RFE, a request for evidence, saying, okay, I get that. Now show me where you got the money from to buy your business. Where did that come from?
So just as an aside, one might think that it's easy to apply for an EB-5 and a green card. The typical I-526 submission is approximately 6 to 9 inches deep.
Easily.
Full of, right, it could even get to a foot.
The funny thing is the I-526 itself
The form's
is
easy, right?
pages.
The form is nothing, so you think, God, anybody can do this, right? You unfortunately you can't. It requires some sophistication and a lot of knowledge.
So an RFE is not a bad thing, but you want to avoid it to the extent possible by submitting the most thorough information you can upon filing, because then hopefully you'll just get an approval without USCIS asking you for more info and then having a delay until you get your final adjudication.
Right, because when you resubmit additional information, it could take another 30, 60, 90, 120 days to get them to rule on it, and you're waiting,
right.
waiting.
Right. So, again, not a bad thing, but it just means USCIS needs more info on something you've submitted.
Okay. How about have conventional banks responded well to working with EB-5 programs other than lien subordinations? What typically arises?
Typically, I would say the biggest problem with the bank is that they're not familiar.
Right, so comfort.
Right.
It's really a comfort. I haven't seen it before.
Educating them.
I'm unfamiliar with it.
Educating a bank on the notion of an EB-5 investment, getting them comfortable with the idea of the financing, and just familiar with the process.
Okay, how about my across the street neighbor who wants to build a nuclear waste site? Will that fly as a EB-5 investment, Liz?
So there's no specific company or business idea that's ruled out, that's strictly prohibited, but if you're doing something that borders on national security, military, some sort of energy project, you might have an issue getting your project approved, or at least it would be super analyzed and questioned.
All right, I'm going out on a limb here. Don't do if that's your business, don't do an EB-5 project and save yourself.
You'll have enough government scrutiny without then trying to bring in a foreign investor into some national security issue.
And the flip side of that is what's really easy. Well, we talked about it a little bit before. Small hotels in the a smaller hotel, a restaurant, businesses that employ lots and lots of people. I don't think real estate lends itself particularly well for EB-5 projects, especially commercial or industrial, because the entity itself that owns the real estate doesn't have that many employees.
Right.
A couple maintenance people, a clerk, a staffer. It's not creating bountiful jobs, 10 for each $500,000 investment that's required. So,
again, you'd have to bring in the economists to do the indirect job and job creation analysis and see what kind of numbers you can generate. But yeah, certainly starting off building something that in and of itself hires people is a great place to start.
okay, last question. The I-526 application has been approved. The conditional green card has been issued. But as you mentioned, Liz, the conditional green card is only good for a 2-year period, and then the government looks back to determine, have the 10 jobs per investor been created? God forbid. What happens when you submit the I-829, the final filing with the government? What if that filing gets denied? What happens?
Well, then the investor does not end up with a green card. The conditional one expires and they don't get another green card. So, but in terms of the investment itself, it does not.
So the money's been released.
The money's been released, so it's been spent. So it doesn't, it's just an I-29 denial, unlike an I-526 denial, does not automatically entitle an investor to his $500,000 back.
It goes according to the terms of the operating agreement or shareholder
Right.
agreement. What were the business terms?
So the investor could stay in the business if he wanted to. If he liked being an investor and an owner in this business, he's free to keep his interest there. If he wants to get out, he would just have to follow the exit strategy that was laid out as part of the business plan.
Okay. That's all for our presentation today. We hope that you found that helpful and enjoyable. We tried to make it a little bit of fun. Liz, always wonderful to do anything with you doing these projects. Thank you all very much. If you have questions, you'll see our contact information on the PowerPoint. Feel free to call us. We have a very active EB5 practice, and I think it's even becoming more active as of late because people are waking up to this. It's wonderful, and there's a high demand to come to the U.S. Thank you.
Thank
Liz,
you.
thank you.